video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Alright, hello and welcome to Camel Finance. I'm your boy Camel and this is the weekend's deep dive where we like to come back and check in on the base case hypothesis of the channel and make sure, largely speaking, everything is still going according to plan. For the stock market, we were hypothesizing at the lows, everyone was too bearish, we were going to run to all-time highs, they were going to cut rates somewhere around the top, and then we were going to enter both a global recession and a bear market. And the key part of this downturn would be that we actually, for a short period of time, slip into asset price deflation, and that any top that we do see come in could potentially remain the top for many, many years to come. You can see we had a bunch of these. This was 14 years, this was 14 years, 16 and 16 years, and the oscillator has to reset during these consolidative periods. So the question is, if we do indeed set a high in the not too distant future, will it remain the high for something akin to a decade while this oscillator resets itself? When we pull up the melt up chart, it seems to me that it is entirely possible we are currently working on that third and final blow off top angle. We know that we have rate cuts as early as Wednesday of next week. I feel more than confident in sitting here and saying this thing is largely speaking going according to plan. The best case scenario for us, I think, is a big blow off top, and that will be me selling a trendline breakdown and looking to flip short on that trendline breakdown. A more complex situation to deal with might be that this is actually going to form some kind of distributive top, something like this, in which case plan B is to sell the second angle violation should it occur. But I do think it's safe to say, largely speaking, this thing seems to be going according to plan. And for Bitcoin, the idea was quite simple. The idea was that this time really would be different, okay? That we would form an all-time high before the halving and ultimately top sometime before November of this year, qualifying this cycle as left translated. And of course, a left translated cycle, since it tops early, implies that there will be an extended, possibly around 2-year bear market decline before we can find that next cycle low for Bitcoin, late 2026. This is the 1 point out of about a dozen that make up the primary hypothesis for this channel that has not been playing ball. It looked really, really positive up to about here. We made that all-time high before the halving. We were expecting a short pullback before continuation. And in fact, what we've had since is about 6 months of consolidation here. So Bitcoin still remains the one component to this entire hypothesis that has not played ball. However, that does not mean we could not see a squeeze to the upside. I remain cautiously optimistic that something like this is coming. However, the more time we spend chopping around here, the more we have to entertain seeing some kind of downside break. To get an update on where we are today, as Tony the Bull so kindly points out, we, I believe, are somewhere in this neighborhood right here, which tells me to keep an open mind about seeing that final push come in. I will also note that many people don't seem to believe this is possible. Sentiment has reached an extreme, in my opinion, and until such time as we either meander out of this sideways or break down from this parabola, then I stand with the expectation of seeing further upside over the coming weeks. As I said earlier, this is the one component of this hypothesis that is not playing ball exactly. However, if it is indeed to squeeze higher, then ultimately speaking, it won't be too far from reality. As I mentioned earlier, a key component after I declare tops is that this recession, this bear market, will also have a deflationary component to it. China is already exhibiting deflation. They have got a collapsing economy. Companies founded is falling off a cliff. The stock market is also taking a beating, down almost 50% top to bottom. The Chinese real estate sector is also getting crushed, as you can see. The same is true of the bond market over in China. Okay, the 10-year bond yield has fallen to record lows of just over 2%. And I think this is going to prove to be a leading indicator for the deflation that is to come in the US and ultimately the rest of the world. Whilst a lot of people have been making the case that inflation is sticky and the risk here is reinflation, okay, I have been consistent in saying that we actually expect CPI to continue to come off before ultimately slipping into asset price deflation, and we have been using this TMC global credit impulse, which typically leads CPI by about 18 months, to tell us this well ahead of time. And I've been making the argument that anything you do to the M2 rate of change shows up in the US CPI, albeit with about an 18 to 19 month lag. So since we had this down, sideways wobble and down in the M2 rate of change, I have been making the argument that we will see down this sideways wobble before ultimately resuming to the downside. Whilst we were experiencing this perceived sticky inflation, okay, that coincided with this sideways wobble right here, I had been making the case for many, many weeks that the majority of the market participants were offside. The majority of the market participants were expecting to see CPI tick back up. And I was saying, no, this is yet to present, and thus it's not going to be too much longer before we start to see inflation drop like a stone. And of course, based on the last CPI print, we have now for the first time, right in that expected timing window, had the big leg down in the inflation data. We are now, for the first time, instead of going from a 3.2 to a 3.1 to a 3, we have now gone from a 2.9 down to a 2.5. And I believe we are just getting started, and that this final leg is going to start to present much, much quicker than most people are ready for. If we pull up the Trueflation data, you can see this trend is starting to very, very quickly accelerate to the downside, with the most contemporaneous print from Trueflation now showing just over 1.0%. My thoughts here are this is either wildly inaccurate, okay, and has diverged away from the real numbers, or if this number is anywhere close to reality, we are likely going to be in deflation by the end of the year. Again, that would kind of make sense based on this M2 rate of change assessment. And of course, it also speaks to the Fed still being very, very late to cut. It still speaks to the Fed being behind the curve. And we can see that here where the US CPI year over year minus the Fed funds rate, okay, it's starting to show these deflationary tendencies down here. Like I said, if that Trueflation print is anywhere close to reality, we're going to see this thing drop like a stone very, very quickly. And then we're going to find out just how late the Fed is to actually cut. Meanwhile, the current rate probabilities sit at just 50-50, 50% in favor of a 50 basis point cut and 50% in favor of a 25 basis point cut. Either way, it doesn't look like we're getting out of next week without seeing some rate cuts, which again aligns nicely with seeing rate cuts mark somewhere close to the top for the equity markets. And if we are indeed going to have a recession and a global bear market, then needless to say, we would expect to see the unemployment spike and the labour market deteriorate. And of course, that is what we've been seeing of late. Non-farm payrolls rapidly approaching that magical 100k level, where moves below historically have always seen us at recessions. Since this chart was created, we have gone from about 209 down to about 140k. So we are rapidly approaching this 100k level. And a lot of people are pushing back on this idea as well, saying things like, well, layoffs haven't started to rise yet. But the problem with this is that history tells us usually only about 2 quarters into a recession do layoffs start to rise sharply. So you can pause your screen and take a good look at this. Okay, is this time going to be different? I don't think so personally. And again, if we look at the unemployment rate at the bottom, it is always a case of gradually, then suddenly. Is it likely that this unemployment rate can suddenly turn down sharply? I don't think so, in my humble opinion. And I think largely speaking, this is because the Fed is so late to cut. Not to mention we have indicators such as the SAM recession rule, okay, which is showing recessionary tendencies. It has officially climbed above the 0.5% threshold, synonymous with entering recessions. Something else we continue to track is the high yield credit spreads. Note at the hard right edge, okay, we had a fake breakout on the yen carry trade unwind, and since then, thinking about breaking out once more. Now, until it does, I don't think we need to worry, but breakouts historically have been synonymous with financially stressed conditions, so a breakout here would not be something to ignore. We have also been looking at the yield curve inversion. The 10-2 has now reverted back above 0, but of course the nuance here is we need to look for acceleration to the upside, and then we see a recession telling us to be open to seeing a month or 2, maybe 3 left in this bull market. But we can see, based on historical data, that every instance of an inverted yield curve coupled with a prolonged sideways trend in the Fed funds rate has told us the economy was heading into an economic recession. Once again, I make the case that these will be cuts not into normalization and a soft landing, but instead will be cuts into a slowdown which have bearish implications for the stock market and risk assets. And fitting in with this theme of seeing economic slowdown, we continue to find that bankruptcies are skyrocketing. The number of bankruptcy filings hit 452 year to date, which is the second largest in 13 years. All of this fits with the main idea in the base case hypothesis that we would be staring down the barrel of a recession in the not too distant future once we got into this rate cutting neighborhood. And meanwhile, there's added complexity because the market participants are divided. Many people seem to think that because global liquidity remains up for the next couple of years, that will be very beneficial for things like the stock market and Bitcoin et al. But the reality is, okay, global liquidity can increase and the market can still turn down. We saw the same thing in the GFC. Global liquidity was rising and the market fell 57% top to bottom. We also saw global liquidity increasing here, and that was just the start of what was close to a 50% bear market top to bottom. The bond market in aggregate is in charge of the Fed cutting cycle, not the Fed. And despite all the narrative and rhetoric out there, the bond market has been pricing in a full-bore recession for close to a couple of months now. on the channel, we have been using the 2-year yield in green as a marker to tell us when the bond market will force the Fed to cut rates. You can see every time the green moves lower, the Fed is forced to cut rates shortly thereafter. And the key part for me, like I said, was that if these are indeed cuts into a slowdown rather than cuts into normalization with a soft landing, we should expect to see the top come in shortly thereafter, just like we saw in all the prior instances. And once more, that fits with the base case idea that they will indeed be cutting rates somewhere close to the top. So what is most interesting to me about this is we are finally here. We have finally arrived at the FOMC meeting, which is scheduled for the 18th of September. Based on the bond market, okay, the bond market is already forcing the Fed to cut, and the CME is not pricing any probability of remaining paused. So I do think we'll be seeing cuts this week. And then, of course, it will be time to be looking for tops. Like I said right at the start of the video, I'll be looking for a blow-off top here. That's the easiest to identify. We get the most profit from the longs on the way up, and we get to flip short at the top. However, we do have to be open to some kind of volatility gains, distribution, and a breakdown, and any breakdown here would indeed be me selling. We've been keeping a very close eye on the Dixie, okay? We want to see the Dixie move lower and find its 3-year cycle low, but I have been saying consistently, if it breaks out of this downward sloping red resistance line, I will be calling bottoms, and I will be looking for that deflationary bust. Remember, as I showed you earlier, the CPI is dropping like a stone, okay? The market is offside because it doesn't think deflation is a risk, and we are getting pretty stretched, as I showed you, in this long-term parabolic blow-off top. Now, if that's the case and we are going to see breakdowns soon, remember, as people sell risk assets, they will flee into cash. They will flee into the dollar for the short-term perceived safe haven that it provides. And when we flee risk assets and bid the dollar, that will also drive a very, very strong bull market in the dollar. And this will be occurring against a backdrop, remember, of inflation dropping like a stone. So I think it's more likely we're going to see deflation than ever before. All the while we're contained under resistance in red, then I have no problem saying we want to continue to aim lower and hope that that provides a bit of fuel to see this final leg higher in the risk assets. But if this thing starts to break out this week or next week, then we will have to be paying attention here because this will certainly pressure the risk assets. For the stock market, we've done a really good job at trading in and out of this thing the whole way up. And we now have a current long on, as you can see here, for the S&P. We know we are due a cycle low sometime around the end of this month or perhaps early October, okay? So the question for me is, does this cycle low form higher up, something like this, and then do we get to load one more set of longs before looking for that final leg? Or instead, are we going to have something more akin to this, where we move lower into that cycle low? And again, that will still represent the final time for me to be adding along before looking for a top, whether that is a blow-off top, whether that is a distribution type thing. Either way, I'm going to be looking for tops, and this cycle low that is due around the end of September or early October is going to be most probably the final time you see me go long before starting to look for tops, starting to declare tops officially and look for short entries. The Nasdaq closed on Friday right into resistance, but notice how it has also recovered the second angle. So is a big hurrah, is a final push coming. The Dow Jones still looks to be moving higher. I like what I'm seeing out of the Dow Jones. It's a fraction of a percent away from closing at all-time highs. Similarly, for the S&P, the Nasdaq, and the Dow, some kind of cycle low at the end of the month is expected. And similarly for all three of these, that will be, like I said, my last opportunity to start to look for longs before ultimately then hunting the top. The Russell 2K, we continue to push the long from the low. The stop is choked up and we're still looking for higher prices. And the VIX trade, we are still looking to see the VIX come off sharply so we can get some hedges on somewhere lower down, perhaps towards the end of this month. And that will protect me against any kind of sudden downside in the risk assets in the stock market. Oil continues to show deflationary tendencies, doesn't it? It continues to make lower highs and lower lows. We have got a cycle low here. I would think that we're now going to play something akin to this into the next daily cycle low. And if you think about it, this makes a lot of sense from both an inflation is not sticky perspective and cutting into a slowdown. If we are indeed going to have a slowdown, then we will need less oil. Gold, we continue to trade this thing. It continues to scream higher, and we are still looking for a yearly and weekly cycle top to come in sometime around the end of this month, perhaps early October. Then for me, the focus will be on reallocating at the yearly cycle low, which is also the weekly cycle low, sometime around the end of the year. We even had silver getting a breakout above the $30 level, so let's see what happens from there. Encouraging signs for the precious metal markets, but I do still believe these days are numbered in terms of the yearly and the weekly cycle. Once we get into this timing window, I do think it will be time to get some more exposure to add to some mining stocks and that kind of thing. And Bitcoin was briefly trading above 60k as of this morning and as of yesterday. So happy days there. So far the cycle low still holding. I do want to see this thing break out of here. Some kind of strong rejection at resistance will not be a positive sign. So keeping a very close eye on Bitcoin. As I said earlier, until we lose this parabola, okay, until we get true breakdowns or meander sideways out of here, then my base case still remains that there probably is one final push higher. And so overall, I can honestly say that things are still more or less operating as expected, okay? We still have the stock markets blowing off. We still have inflation dropping like a stone whilst everyone thinks it's sticky. We still have rate cuts showing up in the expected timing window. We still have unemployment spiking and labour market deterioration right in the window where you'd expect to see it. We still have things like the yield curve and the SAM rule flashing recessionary indicators as we approach the time when we should start to look for tops. And so it remains today that the only real missing component here is that Bitcoin just hasn't broken to new all-time highs just yet. If you're a level 3 member, look out for the members only video coming for you guys. For everyone else, there is a cycle video coming tomorrow, and I think you really ought to pay attention to what those cycles are suggesting. They are pointing to tops in the next couple of months, so please tune in and check that out. Other than that, I hope you're doing well in life. I hope you have a fantastic weekend, and until next time, take care from me. All the best. Cheers. Bye.
Camel Finance, he's the man to see. Rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. Sticking to his guns in his money game. He's a badass, oh yes indeed. Camel Finance got the markets key. Taking us normies on a